This is Scott Becker with the Becker Private Equity and Business Podcast. Today we're discussing a concept from one of our books, which is Blocking and Tackling 60 Keys to Building a Business and Managing Your Money. And you got to remember, I'm not a financial advisor. It's just a hard knock experience, things that have gone right and wrong. But today's discussion is emergency funds and how much. So the amount that somebody needs is an emergency fund. And this is quite frankly true of a business or an individual family either way, and it's probably true of nations too. Whatever you think you need in emergency funds, and whatever your financial advisors think you need in emergency funds, my perspective is you probably need 2 or 3 times that much, because you sort of need emergency funds for true emergencies, and you really never know when they're going to hit you. And those emergency funds have to be in readily accessible assets. They can't be in assets like the stock market that go way up and way down. They can't even be in long-term treasuries or long-term CDs. They got to be things that you could access. Now, every money manager will tell you something different. Oh, you want to minimize your amount in emergency funds so that you have more in assets that can go up or that could appreciate. And there's a mixed bag to that. I'm always a believer in safety first and cushion first. So when they say that, you got to remember every money manager makes money when your money's invested with them, first in equities and second in bonds, and lastly in money markets where they get maybe just a few basis points. So the concept is they have an incentive to be aggressive about telling you only need so much emergency funds. I could tell you from life experiences, and again, I'm getting old, that the more in emergency funds, the better. And that doesn't mean you have 10 years worth in cash, but it does mean if your advisor tells you a month, 2 months, 3 months, that you really need 6, 12 months. And what does that mean? You know, somebody says to me, if somebody's got $100,000, that means probably 50,000 of that's in cash, 50,000 of it's in your S&P equity fund. So that 50,000 is really, truly your emergency fund. As you get to have 200,000, 300,000, 400,000, that ratio will get better. You might still only need 50, 75,000, 50,000, whatever the number is, whatever it takes you to live. If you spend 5,000 a month on living, then I would want 6 to 12 months in an emergency fund. And then everything in excess of that, you could allocate how you want to allocate your assets to equity funds versus treasury funds versus others. But the reality is, whatever anybody tells you need an emergency fund, think you need 2 to 3 times that much. And then you start to really look at your investment assets, your investment portfolios. So when people talk about, you know, your portfolio should be 50% equities, 50% bonds, or 50% money, whatever it is. The reality is, I would think of those numbers after your emergency fund. So first you have your emergency fund, then you think about your allocation to assets, you know, 50-50, 60-40, whatever the number is. But again, the concept is anybody who's an investor or running a company, running a family, think twice as much in emergency funds as whatever advisor tells you. That's my thought for the day. If you like this podcast, feel free, of course, always to text me, 773-766-5322. Say in the text, you know, podcast on emergency funds. I know what you're talking about. And if you're the first one to do so, we'll send you a $100 Amazon gift certificate. Thank you for listening to the Becker Private Equity and Business Podcast. Thank you very much.